Warren Buffett's secret to reading financial statements like a pro isn't some complicated formula or insider trick. It's about focusing on the fundamentals and asking the right questions. Buffett looks beyond the numbers and zeroes in on what those numbers reveal about the business's health, sustainability, and long-term value. First, Buffett emphasizes starting with the income statement, the profit and loss statement. This report shows how much money a company is making or losing over a period. But here's the key: Buffett doesn't just glance at revenue or net income. He digs into profit margins, which reveal how efficiently a company turns sales into profits. High and stable profit margins often indicate a competitive advantage or moat, which Buffett loves. Next up is the balance sheet, a snapshot of a company's financial position at a specific point in time. Buffett focuses on the quality and quantity of assets and liabilities. He prefers companies with strong assets and manageable debt. Excessive debt is a red flag because it can drain cash flow and increase risk. Buffett particularly looks for companies with plenty of equity, the money that belongs to shareholders after all debts are paid. Then comes the cash flow statement, often overlooked by beginners but a favorite of Buffett's. It tracks how cash moves in and out of the business. Buffett focuses on free cash flow, which is the cash left over after the company pays for operations and capital expenditures. Why? Because free cash flow is what a company can use to pay dividends, buy back stock, or reinvest in growth. If a company has strong free cash flow, it's generating real money, not just accounting profits. But Buffett doesn't stop at the reports themselves. He dives into the notes to the financial statements, which reveal important details behind the numbers. This is where companies disclose accounting policies, potential liabilities, or one-time events that might skew the results. Buffett reads these carefully to avoid surprises. Another part of Buffett's approach is comparing financial ratios over time and against competitors. For example, he looks at the return on equity, ROE, to see how well a company is using shareholders' money to generate profits. A consistently high ROE is a green light. Similarly, he watches the debt-to-equity ratio to assess financial risk. Buffett also pays close attention to trends. One good quarter doesn't make a company great, but steady, long-term improvement in profits, margins, and cash flow usually does. He's skeptical of companies with erratic or declining results. One more secret: Buffett focuses on understanding the business itself, not just the numbers. Financial statements are just one piece of the puzzle. He asks, does the company have a durable competitive advantage? Is the management trustworthy and capable? Will the business thrive decades from now? These qualitative factors help him interpret the quantitative data. In essence, Buffett's secret to reading financial statements like a pro boils down to discipline, skepticism, and a focus on quality over quantity. By analyzing profits, assets, cash flows, and footnotes, and always keeping an eye on the bigger business picture, you can unlock the true story behind the numbers and make smarter investment decisions. Stop chasing flashy metrics or quick wins. Instead, build your investing foundation on understanding these core financial statements deeply, just like Buffett does. That's how you separate good companies from great investments.